Don Luskin, I know you're turning cautious on the economy, but can we put away this double dip business? Didn't the economy and the recession bottom last June? Aren't we in some kind of expansion?
Yep. We're definitely in a recovery. The question is whether we're in an expansion. What caused the crisis that ended up in the stock market bottom of last March 9th? There was a worldwide global banking collapse, there was a monetary deflation, and there was a U.S. political crisis. All those things have solved. All those things are solved. You go check, check, check. So you take away the causes of recession, you take away the recession. The problem is, the thing that's keeping us from turning this recovery into an outright expansion is there are so many costs and side effects and uncertainties about the terrible ways that government intervened to resolve all those problems. We still have to shake that off. But, you know, by the end of this year, a lot of those uncertainties are going to go away. By the end of this year, we're going to have a Republican Congress and a Democrat still in the White House. That is the political sweet spot. It's going to be great. And, you know, just be patient. But until that happens, we're not really taking off into any kind of big growth path.
All right. Don Luskin, a couple of issues here I want to explore with you. Number one, in the Treasury market, 10-year Treasury rates are settling in around 3.60%. They got it 4.25. They've retraced back. Now, I would think if we had a really strong economy, the Treasury rates would be 100 basis points higher, but they're not. What's your take on that one?
Well, it's an ironic sort of chicken and egg situation, Larry, because the reason why the Fed is holding the Fed funds rate as 0 is in order to keep the 10-year yield at somewhere in a range between 3.5 and 4, and that is designed to create that very growth, which, when it happens, is going to cause the 10-year yield to go up by 100 basis points. So think of this as the precursor.
Loans are still falling. You want to talk some more about that? I mean, corporations, businesses are flush with money, flush with cash flow, and flush with profits. Should we really be worrying about bank business loans right now?
Yeah, you ought to be worried for a couple of reasons. One, it's because it's big companies that are flush with cash, but it's little companies and the little people who are going to create the little companies, that's the source of innovation and job creation that has always been what's driven expansions in this country. So don't tell me that Cisco and Google and Microsoft have billions and billions of dollars in cash. That's not the issue. The question is whether some entrepreneur in East LA who wants to open a new beauty shop can get a small loan in order to do that. And the answer is no. Now, if you look at all the survey statistics that come out of institutions like the Fed that look at, on the one hand, bank lending standards versus, on the other hand, demand for loans, you find that bank lending standards have stopped tightening. So it's not so much that credit isn't available as much as it is that borrowers really aren't all that interested in borrowing. And that's kind of a sad signal. That's a signal of, it's a vote of no confidence in this economy. When that changes, we'll go from recovery to expansion.
John Riding, do you agree with Don's analysis? We're going to get to the jobs report tomorrow in a minute. Do you agree with John's credit analysis?
Yeah, I do. I think there is a problem of the lack of demand for credit, and we've had no inventory cycle yet. We've ended destocking, but we haven't begun to restock. And a lot of business credit demands are related to the working capital needs to hire people and put people back to work and to put goods on the shelves. And those two components of the recovery are missing so far. The recovery, to a large part, has been driven by cutting back on how much we've been cutting back on goods on the shelves. And so I think we will see that credit recovery. But I do think there's a slight problem with the recovery. The big businesses do have access to credit through the capital markets, not so much through the banks right now. And I do think some small businesses are shut out a little bit. But jamming credit down them if they don't want to borrow is not going to give us a recovery.
You know, on the issue of businesses borrowing from the bond market, the credit spreads have come back in. I don't know if we have the picture or not, but the so-called high-yield junk bond spread against the treasuries has really narrowed a lot. Now, that's true in the last 15 months. We had a little upturn there for a couple of weeks, but it's coming back down, Don Luskin. I got to tell you, this is an argument made by my friend Mike Darda, and you guys know him very well. Mike Darda says, as long as these bond market credit risk spreads are narrow, as long as the Treasury yield curve is steeply upward sloping, meaning long-term rates are almost at record levels above short-term rates, these are very strong pro-recovery economic growth signals. Do you agree?
Yeah, absolutely.
So that's a good sign.
They're not necessarily expansionary, but they're definitely recovery-ary, if there is such a word. For
so
sure.
what are all these dopes talking about a double-dip recession? I mean, I don't understand that point of view at all. I just think that's fear-mongering. Fear-mongering.
They're dopes. You got it right. I mean, they're just wrong.
You know, for some reason, this is an attitude. We live in a culture where the perma-bulls and the perma-pessimists are kings and queens, okay? And guys like you and me, who sometimes err on the side of optimism, we're like the goats, all right? John Riding, you're someplace in between. But I don't know why. I mean, this is America. You got a free market economy, at least unless these tax and regulatory things go through. And I agree with you, Don, for God's sakes. Most of that's going to get stopped because America's in full revolt against Washington.
Yep.
So how bad can it be, for heaven's sakes? John Riding, talk to me about tomorrow's jobs report, because you're a real pessimist on this number.
Well, only in the sense that I think that the snowstorm that shut Washington, D.C. down for several days, which was actually the most positive aspect from the weather in that particular week, to seeing a foot of snow in Dallas, which is a record one-day snowfall, to big falls throughout the Northeast and Midwest, is going to have an impact like the snowstorm of January 1996 had an impact. I think we're going to see a big jobs decline, but only because of the survey methodology, which is a snapshot of employment in a week when we had these big storms. I think in March we bounced back from that. If I'm wrong,
so you're saying
I'm happy
what?
to be wrong, but I don't think it's anything fundamental.
What's your number, John?
We're down 250,000 on non-farm payrolls.
That's a big number.
Whoa.
I think the consensus is sort of plus or minus 50, or maybe plus 50 minus 150. I don't know, John. That's a rough number. That's not going to be well. Don Luskin, I'm not going to ask, unless you really want to give a jobs forecast, but if John Riding were to be right, what's that mean for the stock market tomorrow?
Well, honestly, I think a number like John's is the whisper number. I understand that the consensus is down 50 or down 65, but I think if we really get a number like down 50 or down 65, that's going to be imaged in the market as a great victory. We're going to see bond yields up 10 basis points. So I think that surprises will be on the good side. So if you're a trader, you're interested in positioning this thing in the futures markets 1 minute before the number comes out, I'd be short bond futures. That's all I'm playing on.
So the money